Now in chapter 3, we start to get into the somewhat of the nitty gritty. That we get into financial statements and budgeting. And, it's funny, typically when people consider these things, when they see financial statements, etc., they get a little bit scared. They think it's accounting and so on and so forth. But the reality is we'll just be touching on it just enough to get you acquainted with some of the accounting language, but more so how it's going to work for you going forward. Something I'm going to repeat. I said this before, and I'm going to say it over and over again. The one takeaway that you have with personal finance, with a personal money management course like this, is that there's an expression that pay yourself first. That's what the objective here is, that you want to pay yourself first. Because oftentimes when people consider saving money, for example, they think of that as some sort of a punishment, meaning that you're not able to spend to consume what you earn. You're being denied something. But the reality is, by setting that aside, you already know this intuitively, and this is something that's been told to you over and again. By setting something aside, you are actually paying yourself, because you're going to be able to consume it when? Not right now, but at a later date. And in addition to that, at a later date, you will have more money, hopefully, based on investments and being a bit thrifty now will pay dividends, is the expression later on. Anyway, onward we go. The learning objectives recognize relationships among financial documents and money management activities, develop a personal balance sheet and cash flow statements. The one thing I wanted to say about the balance sheet in accounting, balance sheet is what's considered a snapshot, where you are at right at that moment in time. On the one hand, you have assets, and on the other hand, you have liabilities. Assets are things that are in your favor, and liabilities are things that you own. Some things that are not just in your possession, but things that you actually own versus things that you actually owe on the other side, the debt side of it, if you will. At any rate, that's a balance sheet. It kind of shows the whole thing. Cash flow statement is just as it sounds. Cash flowing in, cash flowing out. The input-output type of a relationship. Your income coming in and your expenditures going out. And the next step we're looking at, objective, is to create and implement a budget. And a budget is what you use to track those expenditures that we just described above, like an expense budget, for example, where you're tracking your income and your expenditures going along with it. Point 4, objective 4, relate money management and saving activities to achieving financial goals. And what that means is, how does this all interconnect so that with your end game being to be able to finance your lifestyle, whatever that might be, what you would like it to be perhaps in the future versus what it actually is right now. It's one of those. That's one of the ways you want to look at this, is that you want to get a handle on where you're at, where you want to go, and how to get there. So objective 1, again, recognize relationships among financial documents and money management. And this is as simple as daily spending and saving decisions are the main element of financial planning. So this is always something that we deal with on a daily basis, and not just on a daily basis, decisions that we make. In economics, another one of the expressions is that we make decisions on the margins, marginal analysis, if you will. And the idea is that we have to make these decisions, weigh our opportunity costs, if you will, on virtually everything that we encounter. We wake up in the morning, do we sleep an extra 15 minutes and suffer through rush hour traffic, or do we get ourselves up, moving, and avoid rush hour traffic? All these things come into play. Opportunity cost. Is the 15 minutes extra sleep worth the extra half an hour aggravation trying to get to work. Those types of things. So we decide these things on an ongoing basis in a continuous fashion. Decisions must be coordinated with needs, goals, and personal situations. Again, this is where we start getting into strategy and tactics. Strategy is kind of long-term thinking, and tactics are things that we do on an ongoing basis. And so these are the decisions that we're making to tie that tactical with that strategic. And it all depends upon our own situations. So money management then is the day-to-day financial activities, it includes the day-to-day activities necessary to manage current personal economic resources while working toward long-term financial security, which is a fancy way of saying it. Watch the pennies and the dollars will take care of themselves. We have to be very cautious, and when I say cautious, we have to think about these things. It's not to overthink, because remember, there's an opportunity cost involved with thinking too much about a decision, meaning you don't overthink the simpler things. Sometimes you just, you go about doing those things on a daily basis. Not that you don't consider them, or not that you don't think about them at all, but you try to set your priorities is what I guess I'm saying. And that's ever changing as well. So onward we go. So opportunity cost and money management. This is again our opportunity cost. Our opportunity cost refers to our next best competitive option. So what we choose not to do, I should say, when we choose something over another. We choose to buy a chocolate shake rather than a vanilla shake. Preferences, so on and so forth. But the point again is that what did we forego? We like both of them, vanilla and chocolate, but we opt for chocolate because we have a higher value we perceive a higher value to ourselves in a chocolate shake, for example. And I'm being far too simplistic, but hopefully you get the idea. These are things that we go over and over again. Spending for current living expenses reduces the amount you can save and invest. Simply put, consume now. If we consume our income now, we can't consume it later. So the idea is that, yes, we consume, but we try to set aside some. And that setting aside is called what we call paying ourselves first. So whatever we can set aside, whatever consumption that we can defer is the focus. So saving and investing for the future reduces the amount you can spend now. That's the flip side of this. So that, of course, means that there's a term called austerity, meaning that you kind of do without. You pull back. You're thrifty. You try to conserve, try to save on your side in the present. Think of this: you're in the country and you don't have the only thing. This is think pioneer days, if you will, if you'd like. But so you're in the country and you don't have access to natural gas for heating or electricity, what have you, for heating. So what do you use? Wood. So how do you get that wood? Well, you can't just take a tree and throw it into the fireplace, right? Or into the furnace, into the stove, what have you. You have to cut that up. So you have to cut firewood. So you're doing what? You're cutting that firewood and you're stacking it aside, setting aside, stacking it so you can what? Consume it later through the winter. Anyways, silly, but you get the idea. Buying on credit ties up future income. Again, it's that concept of buy now and pay later. Yes, you're able to consume something now, but if you borrow, that means that you will be paying for that later on. It's not to say you shouldn't do it. That's another decision that you make, but this is the reality. If you consume it now, you can't consume it later. So if you consume your income plus an additional $50, you have to pay that $50 back out of what? Future income. Using savings for purchases results in lost interest and depleted savings. Again, this is opportunity cost. And one thing to keep in mind is that remember, paying yourself first means setting something aside. And if you don't do that, if you don't set it aside, you take away your saving. And if you take away your saving, you reduce your, you not only do you eliminate the principal, the amount that we're talking about, plus that time value portion, that interest that's associated with it. And once you make that decision, remember, opportunity cost, what that dictates is that when you buy something or when you consume something and you forego or don't buy or consume something else, you can't change that. And that's what we call sunk cost. Sunk cost means that it's over and you can't do anything about it. This is the territory of regret. And all of us have that. Again, when we talk about when we buy something, we regret it, sometimes immediately, sometimes later, sometimes not quite so much, but just the same, there always is some tinge, some hint of regret. Finally, comparison shopping can save money, but takes valuable time. Again, opportunity cost. So you put the time in up front. Oftentimes, when you haven't purchased something in the past, it takes a lot of effort. It takes a lot of energy. The first time you purchase a car, you go through many, many steps that they're hard fought, hard won, hard learned lessons in doing so. And the point is that we make mistakes, but the more that you can actually comparison shop and more that you can research something, the better off you are typically, okay, to a point. So money management activities, the first exhibit we're looking at is that starting from the bottom left is that storing and maintaining personal financial records, creating personal financial statements, balance sheets, cash flow statements, etc., of income and outflows. Finally, creating and implementing a plan for spending and saving budgeting. So these are the steps that are involved in gathering your experience, documenting your experiences, if you will. So the first part is that, again, storing and maintaining personal financial records and documents. This is as simple as keeping a checkbook. This is the old expression, and everything's now electronic, but still it's the same thing, meaning that on the one hand, you have it in your account, and the other hand, you spend it, so you keep track of those expenditures. You keep track of what is coming in. And again, the second piece of that is creating those financial statements, those balance sheets, so that you're able to look at the balance sheet is current, so all your data up to date, where you're at that moment in time, versus cash flow statements, income and outflows, which is those are income statements is really the term in accounting, but the idea is to be able to track your expenditures over a period of time. Balance sheet, snapshot where you're at, and the income statement or the flow statements, the cash flow statements are focusing on what? On over looking at your expenditures and your income and your expenditures over a period of time. And the last part, again, is setting up a budget so that you can track all these expenditures, these inflows and outflows. Okay? So personal financial system, this is, this can be as simple as keeping mental track of these things as involved as having spreadsheets and putting together, documents to show, to track all of your expenses. At any rate, so it's an organized system of financial records, and you're basically trying to handle your daily business affairs, such as paying bills. So this is an ongoing tracking system that we're looking at, and we're building upon that to plan and measure financial progress, what your goals are, etc. Completing required tax reports, and that's when we do file our taxes. So we want to keep things in order for doing our taxes, medical expenses, etc. Making effective investment decisions, and that is again tracking those outflows, that part that where we are paying ourselves that investment, making those investment decisions, right? Determining available resources for current and future spending. So what that means, again, is that understanding what your income streams are. what do you have available to yourself so that for your spending needs? Home file, safe deposit, computer, cloud storage, anything you can think of. You can put it on a piece of paper. You can write it on a piece of paper and use a notebook, whatever you can use to try to track your expenses. That you can again go so far as having safe deposits and typically just put on a computer, and then the cloud storage, of course, is just your memory that you have that's saved either on your computer or in this case the cloud. Okay, home files, home computer, online, items in your home file, personnel, employment records. These are just typical things that you would keep. And it's funny because when we talk about these things, compiling them, putting them together seems like, on the one hand, it's something very, very simple. On the other hand, it becomes complicated because we overwhelm ourselves. Take a little bit at a time. Your personal employment records, keep that, organize it that way. And then working on your money management records, and your tax records will flow from that. Financial services records, if you have any kind of financial statements that would be used there, credit records, credit card purchases, so on and so forth. And you don't have to keep all paper, of course, right? Consumer purchases and automobile records, such as titles and so on and so forth, associated with the proof of insurance, registration details, etc. Housing records, again, the details involved, like with a mortgage, etc. Insurance records, investment records, which goes further, in terms of the financial services records, where your investments are, what the status of your investments, and finally, it's something that we'll get to at the end of the class, is estate planning and retirement records. So safe deposit, fireproof, home safe. I'll keep this very simple, just to walk through. It's very straightforward. Safe deposit box is something at a bank. So you buy space at a bank to put your valuables in, including such things perhaps as passports, marriage documents, insurance papers, so on and so forth. And again, birth, marriage certificates, citizenship, military papers, adoption, custody papers, things that are very, very dear to you. A copy of your will, last will and testament, rare coins, etc. And you can also have it in the fireproof home safe, which I went out on my own, and I got a fireproof home safe. And what happened? I'm not going to say I did it, but the combination was lost probably within a month of getting the fireproof home safe. The good news is there's nothing in it. But anyway, onward. Personal computer, tablets, phone, records on your personal computer, scan copies of documents. You try to compile what you can, what makes sense, not to overwhelm yourself, but to make sure that you hang on to things that are of importance. And this is where it's important to back up your computer. All the things that we tell ourselves to do, we don't do, but we should do, and that's something that if we get into the good habits, this is what we're talking about, is developing good habits along the way, right? So onward. How long should records be kept? Birth certificates, wills, social security data permanently, of course, and there are some things that you should remember. Your own birthday, of course, or your partner's, your spouse's, children's birthdays, and you should also, for sure, remember your social security number. Mine is, no, I'm not going to share what mine is, I'm just kidding, but you get the idea. These are things that you should keep safe in terms of know where they're at and in a secure place. Keeping records on property investments as long as you own them. Mortgage data, how to access your investments, and so on and so forth. Keep documents related to purchase and sale of real estate, etc. That was what we had just talked about with mortgage papers. Tax returns, supporting data for 7 years. And that's something that you should do. You should have a handle on that. And since most of this stuff that we do with taxes is online now, we still should be keeping our hard copies. If we file, if we have itemized, we'll get into that as we kind of go forward. But you should hang on to that data for 7 years if you can. More, well, not too much more, but just keep 7 years. Personal financial statements, part 2, develop a personal balance sheet and cash flow statement. So the main purpose of the personal financial statements is include reporting your current financial position in relation to the value of the items you own and the amount you owe. This is back to what we talked about. On the one hand, what you own, and the other hand, what you owe, and matching those two together, and to arrive at whatever's left over. Meaning whatever's left over between what you own and what you owe, that's your net worth. That is the residual value, what you have left over. Measuring your progress toward those financial goals. This is the reason why we hang on, why we do these financial statements, to see how you're doing, how you're progressing. Maintaining information on your financial activities. Provide data you can use when preparing tax forms or applying for credit. I can't tell you whether we're talking about trying to do taxes and it's not a big deal for you probably at this time, but the better, again, keeping, these are good habits, these are good practices to have. And because at some point in time, you're going to need things to compile taxes. They're not going to be absolutely simple, perhaps, as they are now. Or if you're applying for credit, you're going to need lots of data, because banks, what they do is they take all of your financial, they want to know your complete financial history and your current situation, etc. So you have to have a lot of these details on hand when you're applying for credit, always. Personal balance sheet, step 1. So this is getting down to the nitty-gritty. It's also called again, personal balance sheet, where you are now. Again, this is a snapshot. This tells you where you're at that point in time. It's also called the net worth statement or statement of financial position. Preparation requires using 3 steps. First step, so we're looking at on the one side. So I've got my hands in front of me, and assets are on the left, and credits are on the right. Debits, rather, are on the right. Excuse me. Let's start fresh. So you have your assets on one hand, and you have what you owe on the other. We'll leave it at that. I'm mixing metaphors. So what you own, your liquid assets, you start most liquid first. So your liquid assets. Liquid means things that you can readily turn into cash without losing value. So if you have a home, it may take a while to turn that into cash. So it's not quite so liquid. Anyways, this is the kind of the order that you would follow. Liquid assets, real estate, personal possessions, and investment assets. So this is, we're keeping track of all these things. We're taking, and when we talk about them, we list them, and we're really looking at what? The value is what we're talking about, financial value. Next part is liabilities. So determine amounts owed. Liabilities are what we owe, okay? So your current liabilities are less than 1 year. Long-term liabilities then are what? More than 1 year. So if you owe your cousin Vinny $50 and he said you have to pay it back in a month, that's a current liability. Whereas if you have a home and you're paying that back over 30 years, that would be considered a long-term liability. Step 3 is combining the two together. So in order to get to net worth, we take assets minus liabilities. So in essence, switching things around, assets equal liabilities plus your net worth. So insolvency, this is a status, if you will, is the inability to pay debts when they're due. So if you're insolvent, means that you cannot, no matter what you do, you're not going to be able to pay your debts. You're not going to be able to cover the cost, if you will, of those liabilities that we just pointed out. So net worth is an indication of your current financial position on a given date. Again, this is a snapshot. Items of value, what you own on the one hand, minus the items that are owed, and what you have left over is your net worth or your wealth. So important point, when you hear the word wealth, people always they find it to be interchangeable, synonymous with income. Not the case. Income means what you earn over a period of time. So what your salary is, what you're being paid per hour over a specific period of time, that is income. What you're receiving for the use of your productive resource labor, for example. I'm getting into the weeds a little bit, but the idea is that income is over a period of time. What you earn for a year. Net worth is that snapshot, whatever's left over after assets and liabilities. The difference between the two, whatever's left over is your wealth. So you might want to say that's your residual income. It's your leftover income, what you have left after your income. It builds up over a period of time, right? So that would be your net worth or your wealth. Ways to increase your net worth, again, it's pretty straightforward. Increase your savings, reduce spending. One hand, increase the inflow, and the other side, reduce your outflow. Some combination thereof. Increasing the value of investments and other possessions, reducing the amount you owe. So it's retiring your debt, if you will, that last piece. So net worth calculation, again, we're keeping this very simple. Household has $193,000 worth of assets and liabilities of $88,000, then the net worth would be $105,000. Assets minus liability equals net worth, or net worth equals assets minus liability, to come to that 193 less the 88, getting us to 105,000. Okay, so the cash flow statement is where did your money go? I like that. So cash flow is the actual inflow and outflow, or an income statement. It's also called. It's at any rate, it's of the cash for a given time period. It's also called personal income and expenditure statement. The process for preparing a cash flow statement is pretty simple. Total cash received over the period of time, your income, if you will, less the cash outflows, what your expenditures are. Income, expenditures, or spending. Income minus spending, total cash flow received, total cash outflows less total cash outflows. Whatever's left over is a cash surplus or a deficit, right? So if you have something left over, that is a surplus, and that goes where? It turns into your wealth. So it's being pushed toward that, or purchasing an asset, something along those lines, which ultimately translates into what? Your wealth, okay? So it's money that you're not spending over that period of time. Okay, cash flow statement one, or step one rather. Record income. So we're looking first at the income. So we're looking at the good guys, all the wonderful stuff that comes in, that's coming in. Wages, salaries, commissions, self-employment business income, saving and investment income, gifts, grants. Gifts are always good, aren't they? Government payments such as Social Security benefits, unemployment benefits, etc. Public assistance like welfare payments, so on and so forth. Amounts received from pension, retirement programs, alimony, and child supports. All these are good guys. These are flowing in, if you will. So you want to record those. And then on the other side, you record your cash outflows. And they're divided up into two types of expense. One is fixed expense. There's a little bit more than this, but anyways, fixed expense and variable expenses. So fixed expense would be something that doesn't change over that accounting period, over that period of time. So it might be your mortgage payment, for example, would be, for the most part, would be a fixed expense. Things can change a bit, but for the most part, many of these things are fixed expenses, or at least conceptually they are. The use of your utilities, even though they go up and down, it's kind of a fixed expense. It's going to be coming in, versus the variable expense. The variable expense, of course, is something that changes. You're putting fuel in your vehicle, but you're driving, for this month's work, you're going to be driving an extra 20 miles per day. So that fuel expense, that gas expense is going to go up. At any rate, and I had mentioned before about utilities, that's where the variable part of utilities comes into play, but you get the idea. Step 3, determine that net cash flow, the difference between that income and the outflows. If you have more, if the income is more than the outflows, then you have a positive result. And if the income is less than the outflow, than the expenditures, then that would be a negative or a deficit. So surplus, good, deficit, bad. I'm being overly simplistic, but you get the idea. So cash flow statements then provide the foundation for preparing and implementing a spending and saving investment plan. So this is the bedrock. This is the foundation. This is the point, where you're able to measure. The metrics is another word that comes up often. So this is where you come up with these are your tools that you're using for measuring your performance, your own personal money management performance. So putting this together, budgeting for skilled money management. This is the objective 3: create and implement a budget. A budget there are a lot of different types of budgets, but basically we're looking at budget in this sense as a spending plan. The main purpose of the budgets are to help you live within your income, always a good thing. Spend that money wisely. Think about it, in other words. Help reach your financial goals, prepare for financial emergencies, develop wise financial management habits. That's really the most important thing on the bottom. Developing wise financial management habits, because what happens? All the ones prior to that, income changes, your spending changes, better or worse, doesn't matter. Some months you're spending more than others. And the goal, again, is to reach those financial goals where you're able to retire at a reasonable age, for example, or to save up enough for a new vehicle, think small. It could be as much as simple as going out to dinner once a week or once a month or something like that, to reach those financial goals. And you always have to have contingency plans. These are all baked into budgets. Contingency plans meaning financial emergencies. Car breaks down. You don't plan it, it just does. And you do your best to guard against it, to offset it, to prevent it from happening, but things happen, right? Those are those emergencies that pop up. And all this flows into your budget. So you're able to track these expenses. And the one thing to always remember about budgets, the longer the time frame that you're looking at for a budget, the less likely it is that it's going to be accurate. I know if you think about it, it makes a lot of sense. Point being is that the shorter the time frame for your budget, the more likely you'll be able to hit that mark. You'll be more accurate, if you will. And that's just another reason why, even though we set up budgets for longer periods of time, it's very important to look at the very, very short periods of time just to get into the habit, if nothing else, okay? So creating and implementing a budget, assess your current, it's always the same painful thing, assessing your current situation. In this preliminary phase, your main tasks are to measure your current financial position, understand what that snapshot is, that balance sheet is, where you're at, determine your personal needs, values, and life situation. Hard choices, because I'll return back to economics here, and that is that you can't always get what you want, but if you try sometime, you get what you need. It's an old Rolling Stone song that your parents or grandparents will be very familiar with. And it's an aside, but Mick Jagger, the lead singer of the Rolling Stones, went to London School of Economics. I'm sure that's where the lyrics came from. But again, you can't always get what you want, but if you try sometime, you get what you need. Meaning that our wants are unlimited, our desires are unlimited, whereas our resources are scarce. Economics is the study of scarcity. Boom, here we go. So you measure your current financial situation, determine your personal needs, values, and life situation. Plan your financial direction. How are we going to do that? How are we going to meet those goals, and how are we going to satisfy our needs, values, and life situation? How are we going to do this? The actual budgeting activities occurs in the phase with setting the financial goal 1, estimating your income, budget for emergency funds, fund and savings, budget fixed expenses, budget variable expenses. What I get a kick out of here is that, remember now, you pay yourself first. Let's keep that in mind. But just the same, it's oftentimes when you start going through these numbers, the scary thing is, especially early on, you find out that there's either not much left over or you have a negative number that you're looking at. The reality is that we don't save all that much, and we can talk about this, but just don't be scared if what you have kind of left over, if you will, to pay yourself is a very, very small portion of that paycheck. It's something that you can change, because again, you can adjust things as you go forward. Phase 3, implement that budget. As you select and use your budgeting system, the phases involved recording spending amounts, and so on and so forth, and evaluate your budget program. This is when you say, oops, well, my budget, I was off by 20%, and there is something I can do about it. So you try to do whatever it takes to adjust, to make sure that budget becomes more realistic. And if the reality is not what you want, to change your reality, to fix that somehow, some way. It's a constantly jiggering, changing, adjusting things as you're going forward. So the final phase of the process calls for you to review the spending and saving patterns. Again, make your adjustments, and then what do? You start over again. Okay. Again, it's possible revisions of financial goals and budget allocation should be considered always. The budgeting process, step one, set financial goals. What is it that you want to accomplish? You want to buy a new car. You want to buy a home. Step 2, estimate your income. What is it right now? What do you expect it to be going forward over this period of time that we're looking at? Budget an emergency fund and savings. So you set aside. You're setting aside. You budget fixed expenses. That car that you have right now, you still owe X amount of dollars, and that's whatever that monthly payment is. Those are fixed expenses. Your variable expenses, try to guess as best you can your food costs, your utilities. And I said utilities is fixed, but you get the idea. Things change, throughout the year. Fuel costs, gasoline costs, and cost to operate a vehicle. All these things vary, if you will. So record spending amounts, record these things, record all of these expenditures, and then divide them up as best you can. Or you should start before, of course, but you get the idea. So we review spending and saving patterns, and just to kind of get a flavor for what's going on, because oftentimes you have an idea. If something happens over and over again, you have an idea that it's coming. Review your financial progress, and finally revise your goals and budget allocations, and start the process all over again. Not necessarily from scratch, but start back with the same process over again. You'll become much more familiar, and it will be something that you'll become much more acquainted with as you continue to use this over and over. So characteristics of a successful budget: a budget will work only if you follow it. So following a diet. Diet works so long as you do what? So long as you follow it, so long as you implement these plans, so long as you put them into work, put them into practice, if you will. Experts advise that a successful budget should be well planned, realistic, flexible, and clearly communicated. All these things that, if we really think about it, make sense. And the one thing that's kind of missing here is that a budget should be honest. I guess that's part of this whole thing that we're looking at. But you have to be honest, because when you're doing a budget, especially a personal budget, you're talking about yourself. So you have to really think about these things. And if you don't feel that you're objective enough, which you never really are, feel free to bounce the ideas off other people. And don't just try to find somebody that is going to say yes. Make sure you find somebody that they won't just say to be dismissive, but they'll actually, consider what you have to say as you talk about these things, possible expenditures, etc. So types of budgeting systems, which one works for you? This is what we talked about before. Mental budget exists only in your head. It doesn't sound right, does it? But the point is that you do these things in your head all the time. How much are you going to need for the week? How much are you going to need for the day? How much are you going to need? Oh, today is Tuesday. You don't bring your lunch today, so you're going to be spending a little extra for lunch. Then not brown bagging, not bringing your own lunch in. Anyways, you get the idea. Things that you put through your head all the time. The physical budget, using envelopes for your expenses, such as food, rent, etc. And I've seen people that do this, and it works very well for some. You just have envelopes set aside, or you have an envelope for your food expenditures, your rent, so on and so forth. And they actually put money aside in those envelopes, sometimes cash, but or write checks and put them in there. And I know that's paper, but you get the idea. Written budget, so you detail plan for, there are all kinds of applications online, Microsoft Excel spreadsheets, and anyways, computerized budgeting system using Excel or software such as Quicken. Quicken is great. It's not necessary, but it's something that if you have an opportunity to try it, it's worthwhile. It's actually a very, very useful tool, and it'll get you a job, by the way. So anyways, online budget, use your bank or financial institution website. There are also budgeting apps that you can always use on your cell phone, which is what a computer, or a tablet, which is also a computer. Anyway, you get the idea. There are a lot of apps out there to follow, and the key to this is that no matter if they're simple in your head, complicated, putting together these paper documents, or putting together an involved Excel spreadsheet, etc. The key is you have to follow these things. You don't just leave them hanging, if you will. So money management, achieving financial goals, and this is objective 4, relate money management and saving activities achieving those financial goals. So you identify your saving goals. What is it that you want to accomplish? You want to buy a new car. You want to save $50,000 over the course of the next 10 years. Set these goals up, and then you work toward that plan. But you have got to set aside money to start with. When I say money, funds, at least thought-wise, you've got to set aside and create an emergency fund for regular unexpected expenses, because they are going to happen over and over again. To pay for the replacement of expensive items such as automobiles or down payment on a house. Again, these are things that it takes planning. So you buy a car, and as soon as you buy a car, what do you have to think about? You start thinking about buying your next vehicle. So you start small. You start saving, a certain amount, setting a certain amount aside, and hopefully that won't be eaten up by unexpected expenses. But you get the idea. For these durable goods, these long-lasting goods, these that are going to take a while to pay off, if you will, as well. You try to save as much as you can toward that end, and in dribs and drabs, kind of going forward. To buy expensive items such as sports equipment, or to pay for a vacation, again, you're setting these things aside to provide for long-term expenses such as retirement or the education of children. This is all setting money aside into your saving. This all comprises your saving. You're deferring your consumption. You're deferring your spending to another, for a later date. To earn income from interest on saving for use and paying living expenses when you are no longer earning income, when you are retired. That's the objective, is to try to set something aside for later on, so that 1, you don't have to work at all, or 2, you don't have to work as much, or 3, you can work and you can still you can enjoy even more by working and having extra money on the side. Anyway, so selecting a saving technique. The U.S. ranks poorly among other nations in saving rate. I have to make a comment here. That's not entirely true. We don't save all that much in some ways. Again, it's a very, very small percentage, low single digits actually. However, that does not take into account such things as Social Security and Medicare payments that we make. We pay into our Social Security system. And we can talk about whether or not that's going to be there at some point in time in the future, or if it's going to be some number less. That's a possibility. It's a distinct possibility, and we won't get into that now, but you get the idea. So what they're trying to do is encourage you to set other money aside. Methods for saving, making saving easier. Write a check each payday. This is what? Paying yourself as a % of your income and deposit into savings. Apps such as, I don't know, I've heard of Acorn, but I hadn't heard of Q Capital or whatever they call it. It can be used automatically small amounts into your saving account or investment program. Use payroll deduction to deduct from your salary and deposit into savings. Typically, companies allow you, they do matching programs so far as investments are concerned, etc. Save coins in a container or spend less on certain items. Take a sandwich instead of buying lunch. These are things to try to guard against, if you will. So remember, always keep in mind, you're not denying yourself. You are doing what? You're paying yourself. Okay? Anyway, so this is calculating savings amounts to achieve financial objectives, convert savings goals into specific amounts. These going across, those are called rows, by the way, and up and down are called columns. All right, so your financial goal is at the top of this column. You're setting aside $6,000 for unexpected financial emergencies. Save for a down payment to purchase a home. Save for retirement living expenses. So these are all things that you are targeting. This is what you want to do. So how you're going to get there is the saving method, single deposit from past savings. So you're just compiling, you're stacking this up in your savings account of some sort. And the next one down, saving for a down payment purchase home, deposit $200 every 3 months. Saving for retirement, deposit $2,000 a year. However that works, that would be like an IRA type of an arrangement or what have you. And the annual interest that they have set aside that they have here are not bad. I mean, they're actually probably close to being somewhat accurate, if you will, or appropriate or realistic. So the annual interest rate for setting aside for financial emergencies at 3%, that's not going to be in a savings account. It's going to be in like a CD, and those are even lower than that now too. But anyway, point being is that you want to set them aside in vehicles. You notice that the interest rates go up from 3 to 4 to 8%. What that means is that you're getting higher rate of return, obviously. So what triggers that in a time value of money sense is that the longer you're away from your asset, your money, the more interest you're going to be earning. So you were saving for retirement, you're 25 years of age, and so you're able to do what? To set the money aside for 20 years. You're able to take on more risk, because with the higher risk you get what? A greater reward. And you need that for a longer period of time so that you can do what? So you can actually retire. Anyway, you get the idea. So savings balances after 2 years based on that 3% return. It's after 10 years, out to 10 years, it goes from $6,000 to $8,000. 4%, you're going from $200 a month, ultimately you're getting to over $5,000 toward what? Toward a down payment in 6 years. And lastly, for savings, if you're looking at it 10, 20, 30 years out, as we kind of mentioned, or 40 years for that matter, it climbs by, depositing, setting aside $2,000 a year. gets you up to $225,000, $226,000 after 3 years. We'll talk more about these as we go forward, but hopefully you get the idea. This is good stuff, and the financial piece of it is not as daunting, hopefully, as you may have thought. Okay, and it's simple, but it's not. It's something that takes a lot of practice to develop the thought process that's involved with budgets and so on and so forth. Very important topic. Anyway, that'll do it for now.